The market just handed us a perfect case study in human predictability. While everyone was celebrating 3 straight years of double-digit gains, the system was quietly setting up its next exploit. You see this every year-end. Traders get comfortable. They start believing their own narratives. They forget that markets are designed by humans, which means they're exploitable by humans who understand the patterns. If you've been wondering why the so-called Santa Claus rally failed, why Bitcoin is hovering near oversold levels, or why the CAPE ratio just hit 39.4, the highest since the dot-com bubble, then you need to understand what's really happening beneath the surface, because the crowd is missing the bigger picture, and that creates opportunity. I'm going to show you exactly how human psychology created 3 distinct exploits in this past week's data, how the system is telegraphing its next move, and what the disciplined response looks like when everyone else is reacting emotionally. So here's what actually happened. The S&P closed December 31st down 0.74%. The Dow fell 0.63%. NASDAQ dropped 0.76%. Then January 2nd, sudden reversal. S&P up 0.69%. The financial media called it market uncertainty. I call it predictable human behavior. First exploit, the failed Santa rally psychology. Humans hate losing streaks, especially during periods when they expect gains. The last 5 trading days of December plus the first 2 of January traditionally see buying pressure. When that pattern breaks, it triggers loss aversion, the psychological principle that losses feel twice as painful as equivalent gains feel good. But here's what the crowd missed. The failure wasn't about fundamentals. It was about positioning. After 3 consecutive years of double-digit returns, participants were already taking profits. The system rewarded those who understood that Santa rallies fail when everyone expects them to succeed. Second exploit, the AI narrative whipsaw. January 2nd brought news of Asian AI developments. Shanghai Byron Technology surged. Baidu gained on AI chip subsidiary news. DeepSeek released research on more efficient AI methodology. Watch what happened next. NASDAQ 100 futures rose 0.7%. Tesla jumped 2.3% in pre-market. The same investors who were selling on December 31st were suddenly buying again. This is herding behavior in real time. Humans don't process information independently. They validate existing positions through confirmation bias. The AI infrastructure story remains fundamentally sound, but the emotional volatility around it creates entry and exit points for those who remain disciplined. Third exploit, the valuation disconnect. Here's the number that matters. CAPE ratio at 39.4. Since 1871, the market has only been this expensive 6 times. The previous 5 instances, the Dow, S&P, and NASDAQ lost between 20% and 89% of their value. But here's what second-level thinking tells us. Valuation is not timing. The crowd treats high valuations as immediate sell signals. The system rewards those who understand that expensive markets can become more expensive, and that timing corrections is impossible. Meanwhile, the data was telling a different story entirely. Initial jobless claims came in at 199,000, well below the 220,000 consensus. The labor market remained stable. Corporate earnings continue growing. AI infrastructure spending is real demand, not speculation. The bond market confirmed this. 10-year Treasury yields climbed to 4.16%, the highest since September. 30-year yields hit levels not seen in months. This isn't panic selling. It's term premium expansion. Duration risk repricing independently of equity risk appetite. And here's where it gets interesting. Commodities bifurcated. Aluminum broke above $3,000 per ton for the first time since 2022. Gold and silver posted their best annual performance since 1979. Industrial metals confirming real demand. Precious metals signaling institutional hedging. The system is telling us something important. Sophisticated money is hedging without exiting. Now, Bitcoin trading near $86,000 with RSI at 33, approaching oversold territory. Ethereum at $2,729, RSI at 32.5. This isn't crypto collapse. It's leverage, unwinding, creating opportunity for patient capital. The crowd sees crypto weakness and assumes the bull market is over. The system shows us forced selling exhausting itself, creating asymmetric risk-reward for those who understand the difference between sentiment and structure. But here's the real insight that ties everything together. The market is operating in a regime where 3 forces are converging. AI spending justifies current valuations through productivity gains. Labor market stability keeps the Fed patient. Geopolitical developments function as volatility injections rather than trend reversals. This creates what I call the late cycle paradox. Participants acknowledge the risks, hence the precious metals hedging. They understand valuations are stretched, hence the profit taking. But they remain invested because the pain of being wrong while out of the market exceeds the pain of losses while in it. This is exploitable because it creates predictable behavior patterns, failed rallies followed by AI-driven reversals, valuation concerns overridden by momentum signals, hedging activity that doesn't change core positioning. The Stoic approach is not to predict when this regime ends, but to structure portfolios that benefit from both continuation and disruption. Core exposure to AI infrastructure and productivity beneficiaries, hedges through precious metals and volatility instruments, dry powder for deployment when fear creates mispricing. The VIX at 14.95 isn't complacency, it's compression. The market building energy for the next regime shift. The discipline required is maintaining exposure to structural trends while managing position sizing to survive inevitable drawdowns. History shows that bull markets climb a wall of worry until they don't. Timing the transition is impossible. Positioning for multiple scenarios is not. The week's data confirms what we've seen for 3 years, a bull trend with elevated risk. The system remains exploitable because humans remain predictably irrational. Fear of missing out overrides prudent risk management. Recency bias creates false confidence. Loss aversion generates volatility around predictable events. Process over prediction. Discipline over emotion. Systems thinking over crowd psychology. The market will continue rewarding those who understand that human nature doesn't change, even when the underlying technology does. If you value systematic thinking over emotional noise, if you want to understand how markets really work beneath the headlines, then subscribe. I'll keep showing you how to exploit the patterns others can't see, and grab the link in the description for the complete framework on turning human predictability into consistent profits. The crowd reacts, we respond.